If you've ever opened a letter from the IRS with your stomach in knots, you're not alone. Most people react in one of two extreme ways: total panic or total avoidance. Both make the problem worse. The truth is, the IRS doesn't jump straight to seizing your bank account. There's a specific, predictable process they follow, and once you understand it, you can see exactly where you are in that process and what your options are at each stage. That's what we're covering today. First, let's talk about what actually makes up your tax bill, because it's rarely just the number you originally owed. There are three layers. First, the base tax assessed, the actual amount the IRS calculated you owe based on your return or their records. Second, penalties. These get added for things like filing late, paying late, or underpaying throughout the year. Third, interest, which compounds on top of both the tax and the penalties and keeps accruing every single day the balance goes unpaid. That's why a bill that started at $5,000 can balloon to $8,000 or $9,000 within a couple of years if it's left alone. Once the IRS determines you owe money, they don't call you and they don't show up at your door. They mail you a series of notices, and each one escalates. It typically starts with a CP-14, which is simply a bill notifying you of the balance due. If that goes unanswered, you'll get reminder notices, a CP-501, then a CP-503. If there's still no response, they'll send a CP-504. This one's important because it states their intent to levy your state tax refund. The final step in this sequence is the LT11 or Letter 1058, the final notice of intent to levy. This one gives you 30 days and includes your right to request a collection due process hearing. Every one of these notices is a checkpoint, and every one is a chance to respond before things escalate further. If the notices are ignored all the way through, the IRS moves from asking to enforcing. There are three main tools they use. A federal tax lien is a legal claim against your property. It doesn't take anything from you directly, but it attaches to your assets and shows up on public record, which can affect your credit and your ability to sell or refinance property. A levy is different. That's the IRS actually taking assets. This could mean garnishing your wages directly from your paycheck, or levying your bank account where they can legally take the funds sitting there on the day the levy hits. In more serious or prolonged cases, they can also seize physical property, though this is rare and usually a last resort. The key thing to understand is that liens and levies aren't random. They follow that notice sequence we just covered. Nobody goes from a first notice straight to a bank levy overnight. Here's the good news: at almost any point in this process, before or even after enforcement action starts, you can engage with the IRS and pursue resolution. The IRS actually wants to work with taxpayers who show up and communicate. They'd rather set up a plan than spend years chasing collections. The path generally follows 6 steps. First, assess your full debt and tax situation. Second, file any past due returns. The IRS won't negotiate a resolution until you're current on filing, even if you can't pay. Third, explore your relief options, which we'll get into in a moment. Fourth, formulate a specific plan and submit your application. Fifth, negotiation and review with the IRS. And sixth, resolution and ongoing compliance, because staying current afterward is just as important as resolving the original debt. So what are those relief options? There are 3 the IRS uses most often. The first is an installment agreement, essentially a monthly payment plan that lets you pay off the balance over time instead of all at once. The second is an offer in compromise, or OIC. This allows you to settle your tax debt for less than the full amount owed, but it's not automatic. The IRS evaluates what they call your reasonable collection potential, basically your income, assets, expenses, and overall ability to pay, to decide whether a lower settlement makes sense. The third option is currently not collectible status, or CNC. This is for situations where paying anything right now would create a genuine financial hardship. It doesn't erase the debt, but it does pause active collection while your situation is reviewed. Which option fits depends entirely on your specific financial picture. There's no one-size-fits-all answer. None of these options move forward without accurate financial documentation. The IRS is going to ask for things like copies of your tax returns for the past several years, proof of income, pay stubs, W-2s, 1099-S, bank statements, records of your assets, and documentation of your monthly expenses. This isn't the IRS being difficult for its own sake. Complete, accurate paperwork is what builds a strong case, avoids delays, and gives you the best shot at approval. It also matters because the IRS measures your expenses against their own national and local standards, which set benchmarks for what counts as a reasonable necessary cost of living in your area. Coming in prepared, rather than scrambling to find documents after the fact, genuinely speeds up the entire process. The most important thing to take away from all of this, tax debt has a process, and that process has an exit ramp at nearly every stage. The earlier you engage with it, the more options you typically have. You don't have to figure this out alone, and you certainly don't have to wait for a levy notice to start taking action. If you're dealing with IRS debt right now and aren't sure where you stand in this process, that's exactly the kind of conversation worth having with a professional who does this every day. Contact TaxProEZ at www.taxproez.com/IRS-notices for help with your IRS notices